What if I told you your car insurance company doesn't actually want you to drive safely? That sounds insane. After all, every commercial says the same thing. Safe drivers save more. Good behavior gets rewarded. Drive responsibly. Pay less. But the moment you actually understand how the business works, you realize something uncomfortable. The safest customer isn't the most profitable customer. The predictable customer is. And those are not the same thing. Ethan learns this the expensive way. 32 years old. Clean driving record. Never missed a payment in his life. He drives a 2019 Honda Accord worth about $22,000. He's careful. Uses turn signals, barely speeds, the kind of driver insurance commercials pretend to love. Every 6 months, his policy renews automatically, and every 6 months, his premium quietly rises. Not by much. $11 here, $17 there, another $23. Small enough that he doesn't call. Small enough that he shrugs. Because that's the game. Insurance companies discovered something terrifyingly profitable years ago. Most people won't fight small increases. A $400 jump triggers outrage. A $14 increase disappears into autopay. So Ethan keeps paying year after year. Until one afternoon, his friend Daniel mentions something strange over lunch. Daniel has 2 speeding tickets, 1 minor accident, and somehow pays less. Ethan laughs. Then Daniel shows him the bill. And suddenly, Ethan realizes something that changes the way he sees insurance forever. Insurance pricing isn't just about risk. It's about behavior. If you like uncovering hidden financial systems like this, subscribe now. Because this rabbit hole gets deep fast. The loyalty penalty. Insurance companies have a term for customers like Ethan. Inertia customers. People who stay for years, use autopay, never compare rates, never call, never switch. In other words, profitable people. Here's what the companies discovered. The longer someone stays with an insurer, the less price sensitive they become. At first, companies lure you in with aggressive rates, cheap first-term pricing, discount stacking, safe driver bonuses, bundling offers. But after year 2, the math changes. Because now they know something about you. You probably won't leave. So instead of competing for you, they slowly harvest you. The industry has a name for this. Price optimization. Not what is this driver's actual risk, but how much can we raise the premium before they notice. That's the real equation. And regulators in multiple states eventually started investigating this exact practice because 2 drivers with nearly identical risk profiles could be charged wildly different prices based purely on shopping behavior. One customer compares quotes every year, the other doesn't. Guess who pays more? Now, let's look at where the real money comes from. Most people think insurance companies make their profits from customers who crash. Wrong. The most profitable customers are the ones who almost use nothing, but stay forever. Think about Ethan. He pays roughly $185 monthly. That's $2,220 yearly. Over 10 years, more than $22,000. And in that entire decade, he files exactly 1 claim. A cracked windshield. Cost to insurer? About $900. That's the machine. The ideal insurance customer is someone who fears being uninsured, avoids claims, renews automatically, accepts annual increases, and stays loyal. Loyalty sounds good emotionally. Financially, it can be brutal. Now here's where things get weird. Insurance companies don't just study your driving. They study your psychology. Some companies track how often you shop for quotes, your credit behavior, how consistently you pay, how long you've stayed with previous insurers, even whether you prefer paperless billing. Why? Because all of it predicts one thing: how likely you are to tolerate increases. This is why two neighbors with nearly identical cars can pay completely different premiums. One is seen as a shopper, the other is seen as sticky. Sticky customers get squeezed slowly, and the increases are designed to feel survivable. That's intentional, because outrage causes switching. Tiny increases create acceptance. The accident trap. Now let's talk about what happens when you actually need your insurance, because this is where the relationship really reveals itself. Ethan eventually gets rear-ended at a red light. Not his fault. Police report confirms it. The other driver's insurance accepts liability within 48 hours. Clean situation. Textbook case. And yet, 6 months later, Ethan's renewal arrives. His premium went up $38. He calls to ask why. The representative explains it carefully. Ethan was involved in an incident. He tries to explain. He wasn't at fault. He didn't file against his own policy. The other driver paid everything. Doesn't matter. The system flagged the event. Being near an accident, even one you didn't cause, even one you didn't claim on, can still affect your rate. The industry term for this is a not at fault incident surcharge, and it exists in more states than most people realize. Think about that. You do everything right. You stop at the red light. Someone hits you from behind. Their insurance pays. You file nothing, and somehow you still pay more, because the algorithm doesn't see innocence. It sees proximity to risk, and proximity to risk is expensive. Now multiply this across millions of customers, each one slightly confused, each one slightly frustrated, each one deciding the increase is small enough to absorb. That's not accident, that's architecture, the claim's illusion. Here's another piece of the puzzle most people miss. Insurance is sold as protection. Use it when you need it. That's the whole point. But the moment you actually use it, something shifts. Ethan's coworker Maya finds this out the hard way. She files 2 claims in 3 years, one for a stolen catalytic converter, one for hail damage, both legitimate, both fully covered, both situations completely outside her control. Total payout from insurer around $4,100. Her premium increase over the following 2 years, over $1,400. Her deductible she paid out of pocket across both claims, $1,000. So Maya effectively paid $2,400 for $4,100 in coverage. And that gap narrows every renewal. The industry calls frequent claimants high-touch customers. High-touch customers get managed. Rate increases, coverage restructuring, sometimes non-renewal letters. Because the ideal customer, remember, isn't someone who uses the product. It's someone who pays for the product indefinitely and almost never touches it. The moment you actually need insurance is the moment you become less desirable to your insurer. Wrap your head around that. You spent years being loyal, years paying on time, years building what you thought was a relationship, and the moment the relationship is tested, you become a liability. This is why so many people describe the claims process as feeling like a negotiation against someone who used to be on your side. Because in a sense, that's exactly what it is. The information gap. So why don't more people fight back? Simple. They don't know what they don't know. Insurance pricing is deliberately complex. Actuarial tables, territory ratings, credit-based insurance scores, telematics data, loss history reports, prior carrier history, every variable layered on top of another. And none of it is explained to you in plain language when you sign. You get a declarations page, numbers and boxes, a premium total, sign here. The companies aren't lying. They're just not volunteering the full picture. Because the full picture would make you shop. And shopping would cost them money. So what do you actually do with all of this? You become a difficult customer. Not rude, not hostile, just expensive to keep complacent. That means shopping your rate every single year, even if you like your insurer. It means calling before renewing and asking directly whether a better rate exists. It means understanding that loyalty is not a financial strategy, it is a feeling. And insurance companies charge you for feelings. It means learning your loss history report exists, knowing you can request it for free, and checking it for errors that might be quietly raising your rate. It means recognizing that telematics programs, the ones that track your driving through an app or device, can work for you if your driving is genuinely clean, or against you in ways the fine print doesn't make obvious. And it means accepting something a little uncomfortable. The system was not designed to reward you for being a good customer. It was designed to extract maximum revenue from customers who behave predictably. Ethan eventually figures this out. He spends 40 minutes comparing quotes online, finds a competitor offering nearly identical coverage for $54 less per month. He calls his current insurer to cancel. Suddenly, they find a loyalty discount they never mentioned before. His rate drops $31 on the spot. He switches anyway, because now he understands the game. The best car insurance customer, from the company's perspective, is someone who never learns what Ethan learned, someone who pays quietly, renews automatically, accepts increases, files nothing, and stays forever. Don't be that customer. If this changed the way you see insurance, share it with someone who's been with the same company for 10 years and has never once called to question their rate. Because the call takes 20 minutes. And it might be the most profitable 20 minutes of their year.